Well, here we are. Hello, hello. Another Tuesday evening, another live show, and great to have you all on already. Good to see so many on. A few new names and a lot of old faves, so welcome back. And I have Damian with me. No problem about him showing up on time, unlike last week with my previous guest, who left me hanging in the lurch for a little while, but we got him anyway. I'll just put the pre-show banner on for a second, just to allow people time to shuffle in and make themselves comfortable, grab a beverage or a drink or something, and then we can get going. As with always, we might just do a quick check-in on the dogs. The dogs are sound asleep. They've loved the less wet weather over the last 24 hours. They've had lots of walks and runs today, so they're going to be quite sleepy tonight. Meteor is the one towards the right, and Luna is the one towards the left. And for some reason, they seem to have scrabbled their bed all over the place, so I apologise for that. But anyway, there we go. It's the doggies. And they are looking remarkably quiet now. You wouldn't believe what they were doing earlier on. They were making a lot of noise. We have possums here at the moment, and they run out and chase them. So they jump off the top step onto the very wet grass and sort of skate across the grass after these possums and make a huge row. So the neighbours don't like it much, but hey, what can you do? Anyway, with that, I think that's enough of a preamble. So we'll take that off and we'll get going in just a second. I'm going to play the introduction and then we'll start the formal show. Stand by. Well, good evening and welcome to this live stream event. Great to have you on today, and a few people love the dogs, which is good. They are, I reckon, it's one of the attractions of this particular show is actually the dogs. And as Vanessa said, she comes early for the doggy cam. So many cords on doggy cam. Yeah, there's a few things going on. Let the dogs loose, said Josh. Yeah, well, we could do. I'll tell you. Once they get going, they're hard to control. Yeah, possums and puppies, said Cross Stitch Ange. Yeah, these possums know to go up the tree as soon as the dogs come out. So what happens is the dogs sort of go with the paws up the tree, trying to get up the tree, but the possums just look down and laugh. So that's what happens. Anyway, with that, just before I bring Damian in, let me just remind you that, as always, we don't provide financial or legal advice. It's a general conversation. The chat room is moderated, so just be a little bit careful with that. But I do encourage you to share thoughts and opinions. And there's a poll there if you'd like to express your opinion about where you think exchange rates are going to go in a year's time. And towards the end, I'd like to reveal that. This is as of the 26th of July, 2022. If you'd like to ask a question, use @WalkTheWorld to get my attention. That's to make sure that I see it in my queue, and I'll try and get your question into Damian. I have enabled Super Chat, which means that you can get your question top of the list if you want, or indeed, if you'd like to make a contribution to what we do here, that would be greatly appreciated. Anyway, without further ado, let me press this button. And Damian, welcome.
Hi, Martin. How you going?
Yeah, very good. How are you going?
Yeah, very well. Very well. So, not raining down here, but it is cold.
Cold? We can't have that.
Yes,
Goodness me.
Yes.
The funny weather. It's been quite cold this week up here as well, but we've had so much rain. We think we've had annual rain in the last month or something stupid. So it's crazy. But markets. What are the markets doing, Damien? What's going on?
Yeah, so it feels like we've just trying to remember the last time we spoke, because we obviously had a big fall in the markets, and then we've had a decent bounce back in terms of what looks to be a bear market rally. I think there's some people who've making some reasonable arguments about why we might be at the bottom. I don't think that's the case. I think for me, what we've seen is the froth has come out of the market in terms of the pricing, and we're just sort of starting to get into reporting season now. Earnings are they're not too bad, but they're starting to roll over a little bit. And I think for me, it's about saying that the next sort of 3 to 6 months in terms of company earnings is what's really going to tell us the story as to whether we as to whether it pulls down, whether we see further downside. So basically, if earnings can hold up, then maybe you can see a market bottom. But if they roll over, then there's further to go, and I do think earnings are going to roll over.
Yeah, well, Rabuni came out today, did you see, and said, no, we're definitely on. It's a long way down to go yet, right? But of course, he's Mr. Doom, right? So what do you expect?
Yeah, that's right. That's right. When your nickname's Dr. Doom, you're sort of almost obligated to. I mean, I guess the thing is, if a lot of the news organisations call him up and say, "Hey, would you guys come on and give the bear case?" And he's like, "Oh no, I'm really bullish at the moment." They're like, "Oh, okay, no worries. I'll give you a call back later when you're not feeling so well." So, but yeah, I think there's a number of at any one point in time, there's always a number of things that can go wrong, and they always talk about markets climbing the wall of worry. There's always these things that everyone can worry about, and despite that, markets usually go up over the longer term. Having said that, every now and again, though, it's you do the worry is big enough, and I think there's enough things going on. Central banks are no longer they've no longer got your back. They're now working against you. You've got problems in China. You've got energy prices globally sort of putting a drag on things, and just the effects of these higher interest rates is sort of really starting to feed through.
Yes. And George has made a witty comment. Rubini said mobile phones would never take off. Well,
right.
But there was an interesting over the last weekend, right? Definition of recession came up in the US, right? So politically, they're now trying to frame a recession not as 2 negative quarters, which of course is sort of the journalistic version of recession, right? They're actually claiming, no, you've actually got to go to the guys who officially declare recessions a recession, but afterwards.
Yeah, that's right. So, I mean, look, there's some positives and negatives to it. I mean, obviously, they usually come in too late. That usually is, oh, yeah, hey, guys, there was a recession last year, and you're like, oh, thanks for telling us, But what is interesting in terms of the way they do it is they say, well, it's not just 2 negative quarters. There's other things that go into it as well, and so you can have a recession without having 2 negative quarters, depending upon what's happening in terms of nominal growth and what's happening in terms of employment and a whole bunch of other factors. And so it sort of comes back to sometimes you go, well, that actually felt like a recession because of how far it pulled back, but the timing happened to be, or you had some weird different accounting thing that meant it wasn't a recession technically, whereas actually there was enough jump in unemployment and factors like that. Okay, that was a recession. Yeah. So I've got sympathy for it, but yeah, there's obviously political things at play as well there, and so I'm guessing most Republicans would like to change fire them, make it two quarters, and except if it happens on their watch, then they'll reverse it.
It depends whether you're in power or not, doesn't it? But of course, Powell is saying, well, there's still a route that we can lift interest rates, quash inflation, not create a recession because there's so many jobs.
Yeah, maybe. It's Look, I think I saw somebody had done an analysis. One of the Fed chairs had done an analysis of soft landings, and they were very generous to themselves and sort of treated. I think 2008 they even treated it as a soft landing, or there was a couple of weird ones where they were like it was a recession, but we'd raised rates like 6 months earlier, and the recession didn't happen until 6 months later, and so it wasn't our fault type thing. But even as you went through those, there's very, very few times, even with the glass half full and the sort of approach to it. There's very few times when you can say that central banks have genuinely had a soft landing, and it's usually been factors sort of outside their control in terms of they've been raising rates and that something started to turn, and then offshore something else there's a boom going on, and that's managed to stop you from sliding. So odds are you're going to go too far. And I actually think there's a couple of things happening now that's going to be that's actually going to make it worse than usual. And those things are that in Australia in particular, we've got this energy shock where, I think David was on your program and not that long ago and talking about it. And so wholesale prices have basically doubled. And so that's going to feed through and give us about 3% more inflation, but not straight away. And so that's sort of relatively locked in over the next little while. And so it's a bit of a lagging indicator. It's not anything the RBA can control. Like you could put Australia into a depression and it's hard to make any difference to power prices because power prices are high because of high gas and high coal prices, which are coming from offshore. And so the amount of that we consume in Australia is just not big enough to affect the world. So so you've got that issue that's going to mean that.
Let me just come in there because we might as well do a quick plug. He's actually coming on the show next week to talk further about that very issue, the energy issue, right? Because obviously he's arguing his view is there is something that Albo could do now that would fundamentally change the energy problem here and actually reduce the pressure on energy prices in Australia, and it's to do with the control of gas, right?
Yeah, that's right. And look, all credit to Dave, and I was joking to Martin, in the pre-show that Dave's been tilting at that windmill for well, he helped write the climate change review with Ross Garnaut. So he's been at it for years, and nobody ever listens to him. Unfortunately, on that issue, like he'll talk openly about it. He writes about housing, and there's 10,000 people want to know what he's talking about. He writes about energy, and there's 3 men and a dog who are interested.
Well,
so
don't tell everybody that, or they won't want to come and listen to it next week. But this is really important, right?
Yeah, that's right. We have a crisis finally. The thing is, this problem's been around for a long time, and the whole market structure is just terrible. Yep. And we've been at the mercy of companies, and finally we have a crisis and a chance to fix it. And so, and hopefully we'll get it done. But yeah, I'm hopeful. I'm not optimistic.
maybe his time has come. Anyways, folks, so mark your diary for next week because that'll be an interesting conversation, and you can chuck a question direct at Damian. And of course, the other factors to think about: the China connection at the moment. There's a lot going on there, which we probably want to touch on.
Yes.
The fact that Russia's ratcheted back the flow of gas now to Germany. Yeah. It's now down to 20%. Due to further maintenance.
Yep, absolutely. That's because of sanctions. It's so. I mean, I think there's obviously something there in terms of gas prices are going to stay high, and it's hard to see what they're going to come down because part of it is I think even if you did get gas prices come down a bit, I think that would encourage Europe to transition faster. So I think there's a sort of pain point where Europe's basically, well, we're happy to pay this price, and if the price comes down, we'll just go to renewables faster, or we'll do whatever. We'll transition away from gas faster, and then the gas price will go back up again. So I think there's that. I think there is. So they're delayed. My other ones, I had a whole list of them in my head. The other factors are what else are we facing? Oh, so we're facing the food. So there's obviously food issues and prices sort of spiking in terms of that. For most developed economies, I don't think it's not a major issue. I think more you'll find that the actual price of food that's embedded in it, say in a cup of coffee, is actually pretty small. The actual coffee in there is quite low compared to the cost of rent and the cost of your staff and all that type of stuff. So if you've got wage inflation or you've got transport inflation and things like that, I think that's going to make more of a difference to the overall cost than the food cost.
Well, I'll just make one point. In my surveys, now more than 16% of households in the surveys have fundamentally changed the way that they're going about food shopping. Right. So that means smaller baskets, or it means switching to different stores, cheaper stores, right? Yep. Or going back specifically late in the day to try and find the late bargains. Yep. Right? Or cutting back on more expensive cuts of meat and looking for cheaper alternative, all of those things.
Yeah, but let me give you an example of one of those ones where you say, "Oh, look, I won't buy a coffee from the barista anymore. I'll just make myself a cuppa at home." He's like, "Well, you still use the same amount of coffee beans. You still had a cup of coffee. Yes, it's cost you something different, but it's actually been the service side of the economy to stuff it." Or you go, "I'm not going to buy my $7 artisanal sourdough bread. I'll go and buy a $1 from the local coals. Well, I've still used pretty much the same amount of wheat. So it's mainly the service industry that sort of suffers from that in developed countries. In developing countries, it's an issue.
Totally different. Yeah.
It is a big issue. Yeah. But in developed countries,
I was looking at Egypt, because Egypt, of course, bread is very, very important in Egypt. It's a fundamental part of the the diet, and in fact they've had riots in the past when bread prices went up, right? And of course they're highly exposed because of these export bans and things. So it really makes a huge issue in some of the developing countries. Yeah,
absolutely. So you can expect probably more. You can expect more political instability, and I think Sri Lanka is probably they've obviously got other mismanagement issues on top of it, but that's sort of the if it's allowed to sort of push in this direction, and you don't get and you do get shortages, then you can certainly see a lot more instability. But in developed countries, I guess where I'm getting to is I don't think the RBA can affect that. Like, we've got this food inflation coming through, but the net effect is it's very hard for the RBA to affect that. And then the housing, just in terms of the way they calculate the housing stats and how they put that in, it means there's a big lag to the amount, plus there's a lag to the. And so I feel as if the main things that are causing inflation this time actually all have a bit of a lag to them, and it's quite possible that the RBA won't even know when they've gone too far, because they're still be looking at, and inflation might still be rising because of either energy or food or housing, sort of pushing it, pushing it up, and so they're not even seeing what's sort of going on.
And of course, we have a quarterly measure of inflation, right?
Yes, yeah.
Whereas many other countries do it monthly. So I
think just about every other country. There's not many countries do it quarterly. There's a handful of them. Yeah.
And of course, the other point is that the way they use the rental numbers in their inflation means that it understates what's really going on in the rental sector, and the cost of housing isn't directly included in the CPI here. It is in some other places, but not here.
Yes. Yeah. So anyway, so I guess what I'm saying is I expect that this time will actually be there's more chance that they'll go too far in Australia in particular, and potentially they already have.
So when you say too far, you mean the rates have gone too high?
Yeah, that they'll push rates. I guess what I'm saying is there's this idea that, yes, we can push rates up to this perfect level, and then we hit the right level and we stop, and we get this nice gentle, and we go sideways for a little bit.
Just gentle landing,
that's right. It's the landing. Yeah, I mean, I think that whole idea of landing an aircraft on water is not a bad, it's not a bad analogy for what the Fed and everything's going to do. Is, yes, you need to tell all your passengers and everything like that, everything's going to be fine. You check your life jackets under your seat and all that type of stuff, but very, very few planes have ever managed to land, on water, and that's the same as central banks with a soft landing. Yeah,
absolutely. Well, there've been very, very few examples of soft landings. Cookie Boy asked, because Leith came on a few times and has said, 1.6 is about as high as rates will go, right? Or 1.35. Now ANZ is talking about 3.35% by the end of the year. The markets are sort of similar. It's a little bit hard to know precisely how high they're going to go.
Yeah. From my take, look, I don't know when the pain point's going to kick in, because there's a lag to it as well, and especially and this is because we had the very cheap 3-year rates. There's more. I think there'll be more of a lag than what Australia usually sees. So you're going to see. So and the speed at which they're going up now is. So I've got a chart there. I don't know if I think I sent it to you, Martin. Maybe not. With the one where they're showing that this is already we've had the fastest change, the biggest change in mortgage, in total mortgage payments. If you take a 25-year mortgage, the total mortgage payment it's never increased faster than what it's done already, and we're about to probably have another rate rise, this week, and so I think what we're looking at is an RBA that's just got the foot flat to the floor and still doesn't quite know what's happening, and right. I don't think they are going to know what's happening. So there's
two interesting observations, right? Michelle Bullock's chart, right, showed that this is the repayment increases of variable rate loans, and what she basically says is that around 30% are going to have a 40% increase in payments, another 12 or 13% will be 30 to 40% This is the increase in monthly repayments. The rest is a bit better. Now, this is sourced from the RBA securitization system, right? Very important to understand what that means. What it means is that they've got data on securitized loans, right? But the thing to understand is that the securitized loans are a subset of all loans that are handpicked.
Right. Because they're the better quality ones.
Spot on. So this doesn't necessarily tell you very much. Second point is that data will be delayed in any case, right? Because the first increases happened in May, right?
Yes.
May, June, July, August, right? That doesn't tell you, I don't think, the full picture by any means.
But that still doesn't look very good.
No, well,
like I said, that looks like, I think there's obviously that argument. There's a whole bunch of people who aren't going to be affected by it, and it's like, that's the economist joke. Is your head's in the oven and your feet are in the freezer, but on average you feel pretty good. And
yes,
I think if you've got, what was the number at that top end with the 40%? Was that 30% of people increasing their mortgage rate?
Around 30% have at least a 40% plus. 40% plus, that doesn't mean just 40%, right?
Yeah.
And there's another 10 or 11% at 30 to 40% higher than where it was, right?
Yeah.
So that's on the variable side, right? And then you've got this one, which is, whoops, push the button twice. Do that one again. There you go. This is the fixed rates, right? So we've got a large proportion looking at 40 to 60% change, right?
Increase in the fixed rate.
And the CBA the other day said, well, that's equivalent to around $500 billion of mortgages in the fixed that's going to be repriced, right?
Yep. And you don't need many of those. Like, I mean, the housing market crashes happen because, 5% of people?
It's the marginal borrower. About 3 to 5% is sufficient to tip it over.
Yeah. So you're looking at there 30% of people with a 40% plus increase. If you only look at those and ignore the other ones, so you need 10% of them to actually start having enough of a problem that.
Correct.
Yeah.
And now let me just remind you, this is of course my data on mortgage stress, right? And I'm at 45% of households. So I'm saying 45% of households are having difficulty managing it all, right? Now, when you put that number in the context of what the RBA numbers showed, it shows that I'm not a million miles off.
No, that's right. And that as it's that time bomb of people who financed at 2% because they were told rates weren't going up to 2024, and we'll be copping a. Anyway,
so let's move on then to talk about the RBA, right? Because the RBA has now got a review. Right. Although the scope of the review is carefully crafted to avoid mentioning APRA, don't mention APRA, and it's quite specific in some of the things it's looking at. So the constitution of the board and some of the ways that decisions are communicated and those sorts of things. And is inflation targeting the best way to manage the economy, as it were? So it's carefully crafted, but how can they review it without thinking about the APRA component? Is the question.
Yeah, especially because most other central banks, they're together, and then they work together in Australia as well. So it's the, it's a part where you don't want. We had a stage there, where both of them were sort of looking at each other and going, "Well, house prices aren't really my problem; it's your problem." The other one's like, "Well, no, they're not my problem. That's your problem." And so you want, if you've got one,
they actually both say it's not their problem.
Yeah.
Right?
That's right.
So RBA says, no, we don't target house prices. And APRA says, no, we're not interested in house prices. Well, hang on a moment. Because supply of credit is the fundamental reason why house prices bubble up, right? I mean, that's why when rates get cut, house prices go through the roof. When rates rise, house prices drop. I mean,
we don't even need rates to rise. We just need the amount of credit to slow down.
Correct.
And they fall.
Correct. Exactly right. And the Peter Tulip model and everything just shows that. And so the rate of change of credit is the critical thing. So everybody knows that. But we've got the situation where our regulators are saying
somebody else's problem. Yeah, that's right. No, it's not my brief. That's and look. There's a you can even take it one step further, which I often do, which is saying, 30 years ago or 40 years ago, maybe before we had independent central banks, is that it's you'd have your fiscal policy and your monetary policy were sort of designed to be working together. So, you're basically going, you have a government that's running things and they've got their hand in both, and they can decide, okay, we're actually going to spend a lot of money, and so we'll keep, and we'll keep rates a little bit higher so the economy doesn't overheat, or vice versa. We're actually not spending much money, so we can have lower rates and whatever, and they work together.
Yep.
Whereas now it's completely separate as well. It's like, well, the government's running its budget, and it's like, well, that's not my problem. If I'm trying to get surpluses, and it means that these guys have to keep cutting rates because I'm trying to get surpluses on this front, that's their problem, not my problem. And vice versa when one's running the economy very hot, and so there's a reasonable argument that if you keep dividing these things into smaller and smaller groups and giving them each one small thing to look at, that there's going to be lots of things falling between the cracks because everyone's just like, that problem seems hard. Maybe it must be somebody else's.
Well, let me give you a slightly additional narrative. The Council of Financial Regulators, APRA, ASIC, Treasury, and RBA. RBA sort of sits as the sort of the secretariat for it, right? I have a feeling that actually a lot of the shots are being called by Treasury, right?
Right.
And to an extent, APRA is responding to Treasury's demand for growth. If you think of when Josh Frydenberg was actually Treasurer, he was very keen on removing responsible lending and making sure that APRA and ASIC support growth. And in fact, his bill that luckily what didn't get up to remove responsible lending was all about economic growth and recovery after COVID, right? That's the excuse he used. So I have the feeling that below the waterline, that's where a lot of the drive is actually, and therefore none of those regulators and the RBA are really objective, independent. And there's a sort of a convenient sort of argument. Well, they're doing that, we're doing that, etc. But actually, there's a bit of coordination going on through the Council of Financial Regulators. Yes.
Well, if I was ever running a regulatory authority and they had a royal commission into how bad of a job I'd done and how all the people I was meant to be regulating were running roughshod over everyone, I wouldn't expect to get reappointed in the middle of it. And if I did get reappointed, I would feel very, very grateful for the person who'd done it. And maybe I'd,
are you talking about the person who's just resigned?
Completely hypothetical. Yeah.
Oh, okay. Let me just make it real, because Wayne Byres has today decided to leave in October, right? Which is interesting timing if you think about with the review of the Reserve Bank going on and other things, that he's decided that everything is fine and it's a good convenient time to leave. Very interesting timing. My reaction to that was.
Yeah, and maybe he was if we hadn't have had the government voted in, we did, he may not have made the same decision.
Yes, I wondered about that too. Yeah. Very interesting. Yes. Now, of course, then that begs the other question. So we've got this RBA review going on. It's going to go on until March next year. They've got these 3 experts, including international expertise, to try and look at it. The interesting question was, will Phil Lowe essentially be then, going to the exit as well, or will he actually get, another few years at the RBA? And it's interesting, the timing, because the timing is effectively the Treasurer will get the report before the decision has to be taken about whether to renew Phil's contract.
His contract or not. Yeah, well, I guess he'll see how things are going with the review, I guess. But what I guess it's interesting for me, I was originally of the view that when Australia hadn't raised rates, and the US had, and the UK had, and New Zealand has, was that that they knew there was a review coming. They knew that they'd erred on having interest rates set too high for years, and they'd overdone it on their forecasts for years, and that this was sort of a bit of a they were going to sort of take a step back and be a bit more circumspect about raising rates, because they say, they keep forecasting that everything's going to be great, and it's never been as great as what they forecast, and so they keep overdoing it. And so that was where it was, and now we've just rattled off a whole bunch of rate rises and a record speed, and we're still going. So it's almost as if he's now on the opposite side about saying, well, look, I'm going to prove that I can kill inflation. If that's going to be my legacy, is that I'll be the person who killed inflation. So I don't know. I mean, I've got no more insight than anyone. But I guess what I'm trying to do is work out what are his motivations going to be in the meantime.
Yes.
That might sort of lead it to pushing interest rates higher or lower than what they might have been. And I was obviously wrong on the whole. He'll be a bit more circumspect. So
my theory is they're looking very much at what the Fed's doing. Right?
Yes.
Two reasons. One is because, of course, the Fed, the US dollar, and second is exchange rates, right? Because obviously, if we go a long way out of line with what they're doing, our exchange rate gets murdered. So we've almost got to follow the sort of trajectory that the Fed does. And because the Fed is now, 75 basis points or 1% later this week, probably. That's going to determine trajectory for our rates here too.
I do think there's a big element of us following the leader in terms of that. Yeah. And I don't know if it's it's almost a bit of a global, where central banks are in this global team together. We're going to slow economies down and bring down the energy cost, which, globally central banks can do it. If you're the US raising rates quickly, you can bring down interest rates. But if you're Australia, you can bring down energy prices because you're big enough to affect, energy globally. Australia's not. That's the part where I sort of feel as if, if we can't affect energy prices, and Europe's in a similar part where Europe's energy prices, most of their inflation is energy, and that's why that sort of made sense to me why they hadn't raised rates yet. But now it looks like they're on the same path as well.
Well, the ECB did 50? That was a surprise.
50,
then out 0. Okay, so they've finally gone out of negative interest rate territory. There's still a couple of countries in negative, Sweden and a few others, I think, and Japan, of course, is still negative rates. But it looks to me as though that experiment's probably over for the time being. Although I have a theory, I could be wrong, we're going to see rates go up, then they'll wobble, then they'll come down, and then we'll end up with lower rates again.
I'm absolutely with you there, and investing for exactly that.
Yep.
Is that rates? Your rates will go up, and it'll be just talk about inflation's here forever, you hesitate to use the word transitory because it's obviously been
overused.
Obviously not been, and it obviously hasn't been transitory. But I do think there was an element of inflation that came out of the supply chain, and the whole inventory cycle, and that was. I guess I'll give ourselves a pat on the back in terms of saying we were talking about this inflation. We published stuff, well before the inflation actually happened, saying, "Hey, there's this inflation boom coming, but it's going to be short and sharp, and then you'll see the other side of it, and it'll come down." And then I think we had the Ukraine war sort of hit as it was starting to come off, and that sort of gave us another leg. But I do think you get to the stage, especially with the interest rates rising at the speed they're going, where things could turn very quickly, and you could even see deflation for a year or two with the amount of extra supply that's come on, and we've still got we've seen all the stimulus from governments being pulled out as well. So the main thing for government spending is not. I mean, the level counts a little bit, but actually, what counts more is the change in the level. And so we've gone from this ultra high level where giving out money to everyone who they could, mainly businesses actually in Australia and mainly businesses in the US, but to consumers as well. And now that money is no longer being given away. That creates that vacuum in terms of growth, and you need to fill that with more people working, and so that's been happening to a certain extent, but it's still a big drag. And then on top of that, you're throwing the monetary policy drag.
Yeah, absolutely. And, a couple of people are asking about, will the RBA stop following the Fed? The answer is no. I don't see how they can.
Well, if the Fed pauses and we've still got high inflation here because of energy prices, because we're far more exposed to this energy problem,
yes,
then maybe we break it in the wrong way. I mean, I'm hoping that the RBA did a 180 in terms of rates when they saw that inflation and the Fed and everyone else was rising rates. They obviously went very quickly switched. Hopefully they'll be just as quick to switch back the other way. But I think but I doubt it. I think they're probably more. I think I've had flack for saying this before, but I think I sort of feel as if you're, if I want to fight fires, I'll join the fire brigade, and if I want to fight inflation, I'll join the RBA. And it's, yes, you might occasionally get a few arsonists in the fire department as well, but I don't think that many arsonists. I don't think you get enough arsonists in central banks that really want to drive inflation higher and push things like that. I do think they look upon Paul Volcker as being this demigod who's revered throughout the world for crushing inflation.
Yes.
And if I get a chance, then that's what I'm doing.
Yeah, absolutely. So, no, there's no doubt in my mind that that's the thing that's nailed on the door over all central banks. Got to kill inflation, got to kill inflation. But there's some consequences, because what it basically means is that you can't now do a whole lot more of handouts to households or more pulling out of super, those sorts of things, because that would all be highly inflationary.
Yeah.
Right?
Well, that's it. Yeah. You've got to you'd think you'd reverse all your interest rates first. And just to give the analogy, I don't know if I've got this chart I can pull up easily enough, but actually I probably do. There's just to give an analogy, in the last pandemic, the last big pandemic, back in the 1900s, you saw pretty much a similar thing. So we had there'd been a shrinking in terms of the amount of trade, because the world trade had actually reached this massive high prior to World War I, and then the World War breaks out, and after that, so trade was coming off. You have this big pandemic. You have interest rates and inflation booming. You have the Fed raising interest rates into that, and then pretty quickly we saw the other side of it, and and we actually ended up seeing deflation in that period. Sorry, I don't know if I'm going to be able to get this up in time, but let me keep talking while he does. So I do think that same analogy of let me pull up this chart. The same analogy is clearly a potential in terms of seeing that same one. So I don't know if I can share screens now.
Yeah, you see, you've got shared screen. Just need to.
I think I better stop and start again.
Okay, that's fine.
And share that one. Yeah. So.
Yeah. You ready to share that?
Yep.
Okay. There we go.
That's pandemic inflation. Yeah. So you can see. 1920 was roughly when you had this pandemic inflation and sort of much higher inflation. You had inflation towards the end of the war as well, but you had this shoot up inflation, sort of 20% at the time, and then the Fed raising rates into that basically as the pandemic was ending, and that all ended up with a depression in the early 20s. Plus you had significant deflation. Now I'm not expecting that, and we're obviously not the same levels of those, but you could very easily see a similar type of, if we get 10% inflation on one side or close to 10% inflation and that turning and getting some negative fives and stuff like that, I think it's perfectly a perfectly reasonable case in terms of the amount of extra supply that's sort of come on in the background and the extra demand for goods that then fades off, and we're very much seeing that already. I mean, that's when you're looking at a lot of the retail sales figures, excluding the Myers numbers today, which look pretty good, but from especially in the US, not only seeing weak sales, but that's weak sales with lots of inflation. So the actual volume of goods that's coming home from the stores is really starting to fall away.
Correct.
And the sales are only holding up because the prices have gone up a lot on those goods. And it's just this weird. You had Walmart overnight. We were talking about these issues, and it's just got these weird bits where they're talking about inflation on one hand, and then rapid discounting they're trying to do to get rid of goods on the other hand. And you're just like, just a minute, how can you have both? You can't have rapid discounting and inflation at the same time. And I guess the point is you've had a lot of inflation, but now you're starting to hit that phase where if you do get that, you do get that other side of it where you do start getting too much inventory and you have to discount that inventory. That's where this deflation starts coming from.
Absolutely right. Yeah, and the point, of course, is that these things start to be a bit of a cascading of a set of events, don't they? They sort of tend to chase each other. And once they start, it's very hard to sort of put the finger in the dark to stop them.
Yes, it is. And actually, that's a good segue into China before we move into too many other things, because I do think it does seem to be brewing that point of that in terms of houses, you sort of take that view that there's lots of countries that say, oh, houses are different in our country. People love them and they invest in them, and and it's all they don't go down because this is what's happened. And I think China seems to be hitting that point where they have held off giving support to their property sector for long enough now, and when I say held off giving support, they've given 1,000 small bits of support, but no sort of major big bits that's actually going to turn that around. Is that they are in danger of hitting that point where people do lose faith in the housing market. You've already got mortgage strikes where people are refusing to pay their mortgages in China. I think there's a very real chance that they possibly have already gone too far, but or they do take it too. As they go, they take it too far, and you get that stage where people lose faith in that housing market, and then it turns into what's been a pretty orderly decline so far into quite a disorderly decline in that market. So
absolutely. Yeah. Well, Jason made the point, and thanks for the super chat, Jason, that is there going to be a run on the banks to account of what's happening in China? If that happens, are they going to be looking enough to handle it, or do people become invested in the banks unwillingly? And it's just worth highlighting that the other thing that's going on in China at the moment is deposits were converted to investment funds, right? And people suddenly found they couldn't get the deposit out of the banks.
Yeah. Now, China's interesting in that they've obviously got a lot more tools than other countries,
yeah.
And
social scores and police and tanks, and just people are having mortgage strikes and they're worried about it, and so they just wipe the internet clean, so that nobody else in other cities can find out that people aren't paying their mortgages. Yep.
So they do have other tools. There is a strong chance they'll bail out the banking sector, and they can step in and do that, and they've done it before. I think it almost plays against their against a good outcome, because when they did it, I think it was 2000, they bailed it out. Maybe it was the 90s,
just late 90s, I think. Yeah,
late 90s. Yeah. And they did all this, these bad banks, and piled all the assets, and that was just before they started this big boom, and it was actually worked out pretty well. Yeah. So we had a housing problem. We basically bundled all the loans into a bad bank. House prices then boomed, and all those bad loans turned into all right loans, or we got most of the money back. And then then that bad bank turned into a hedge fund, and the guy ended up being killed because he was executed because of the loans he was making. But we'll leave that off to the side. It almost worked out so well that you can see that there'll be people in there who are going, that's fine, we'll just throw all the loans in a bad bank and it'll be fine. And it works, but that trick only works when house prices are going up. And if you've already got people paying massive multiples of their income and they just can't afford it, then the bad bank becomes a big drain. So sort of a long roundabout way of saying, I think in terms of China, they've got other tools. I think they can use those tools, and they'll try and socialize a lot of these losses. But it doesn't mean that. So what that means is, I think you end up much more like Japan than what you do in, say, Spain or something like that. Yep. So, and what I mean by that is Japan just, that they effectively had a lot of companies that were all overgeared, and they basically got told to buy the other companies, and so you got the good companies turned into bad companies, or too much debt. And then interest rates were raised low enough that those companies wouldn't go bust, and they just had to work their way out of it for 20 years and sort of just gradually pay down that debt. And I think that's the type of thing you're probably expecting, or certainly the type of thing I'm expecting in China in terms of what's happening there. And keeping in mind as well that China's got a like the tax. It's just got so many different things, like the way it taxes people. Effectively, if you're really rich, you can avoid paying tax because you got lots of different ways to stick your money in different funds and clear away. If you're in the bottom 70 or 80% of people, you don't pay tax anyway because you're running a market stall and everything's cash and they don't pay tax. And it's actually only a very small sliver of people who are rich enough to have a job that pays relatively well and end up paying the tax. And so that's on one side. And then on the other side, there's one part of the tax. So the main part of the tax really comes from local governments who have been selling off land to then do construction, to then sell off more land and do more construction. And so it's a really pro-cyclical thing that when it works great on the way up, it turbocharges things on the way up, but on the way down, all of a sudden these guys don't have any money. And we saw, it was about 2 weeks ago, we saw this big rally in metals prices for a couple of days because China had come out and said, we've got all these, we've already reached our debt limits, we've already lent all this money for infrastructure, and we're going to bring forward all next year's quotas. We're going to let people use next year's quotas this year. And the initial thought was, hey, that's fantastic. They're building all this extra infrastructure. Like, no. There's no more infrastructure being built. The same amount of infrastructure, or it's 10% more than last year, but the same amount they were planning on building. It's just they've run out of money because they've got no land to sell, and so because they can't sell their land, and so they've had to keep drawing down. And so, the actual use of the funds, or the actual building isn't changing. It's just it's how it's being funded. And so you've got so many parts of the Chinese economy in that way that I guess what I'm worrying is, it could unravel quickly and get unruly. And I do think you'll see bailouts and stepping in, but it doesn't mean that it's not going to be very bad for world growth, and in particular for countries like Australia who are very leveraged to that whole Chinese building cycle.
Yeah, well, if you think about the amount of stuff that we ship up to China, it's 37%-ish, I think, of our total exports go to China, give or take. LNG is the biggest now.
Yeah, that's right. And so, there's. Oh well, let me leave Dave to go. I could go on for that, but Dave's going to hit you up for a whole hour on that, so I won't steal his thunder. But yeah, there's obviously lots of I have spoken in the past about that we collect 10% of what Qatar collects in producing the same amount.
I know.
And
yes. How does that work? But there you go. Now, one of the other things that is worth thinking about is with these various levels of uncertainty around the world. I mean, we've touched briefly on the gas. We've touched on the exchange rates in the US. We've touched on China, right? My question to you is, how on earth do you try and weigh all of these factors up when you're making investment decisions, right? Because you got a portfolio there you're trying to manage, and you're trying to, on one hand, say, well, I want to try and get some returns, but I also don't want to lose too much. And where's the dial at the moment between not losing too much and trying to actually make returns?
Not losing too much. I think there's money to be made on bonds. I do think there's a genuine opportunity there. So yeah, that's one spot. I think it's more about not losing too much on the other side, and you sort of got to look back at markets have had a pretty good bounce over the last couple of weeks, and so July to date. When you look at the stocks that have done it, there's some of the pretty high beta stocks. So your Teslas and your Nvidias and stocks that are really trading on these massive multiples have sort of led the way. That's always a little bit concerning in these. That maybe it's the start of a new boom. I doubt it. Booms, if there was a genuine, we've seen that deflation in that whole sort of high beta area, and the risky stocks. They've very much deflated this year, down 40-50%. A lot of them is if there's going to be another boom, it's very rarely is it within 6 months of the last one. Usually you'll see it's this will last for a couple of years before people are sort of really willing and ready to throw more money at that. So yeah, so we're still on the defensive side, and I guess the part as well is where I'm getting to with that is I'd be cautioning people about getting too excited or too depressed on either way. So yeah, we had this massive pullback last month, down sort of 5% in most markets, and then this massive rise in a lot of these worst hit stocks this month. I think you'll see the reverse happen. I think if you're trying to chase the trends and trying to jump into those stocks now, you're going to be playing catch up the whole way, zigging when you should be zagging. So, yeah, I'd say this latest run is a good chance if you've got too many growth stocks in your portfolio. It's a great chance to sort of start tipping some out.
Get them
and then
out,
as
yes.
as the fall happens, don't sort of you go, oh, market's down 5%. I've got to sell the next batch and buy a whole bunch of defensive stocks. It's like, well, maybe it's leave those ones for a bit, wait for the bounce back, and then the next rise before you start tipping again.
And this is NVIDIA actually. I thought I'd just show you the latest chart, right? So it's sitting at around 170 at the moment, right? And it's just worth looking at this, right? November last year, right? It was up to 340. Right?
Yep. So you've more than halved.
Yeah. And if you go back to May last year, right, we're pretty much where we were now. So in other words, you could say that the last year, right, has been completely weird, right?
And have you done so in the last 3 weeks or so? You've probably done 20% at least. Where are we? So yeah,
so it's gone from the lowest of the low was 142, and today it's sitting at 170.
Yeah. So so more than 20%.
Yeah.
So
yeah, and quite a few of the tech stocks have done something similar, right? So now, of course, we do have some major tech results coming over the next few days, Amazon and a few others, right? So it'll be quite interesting to see how they actually shape up. But a lot of the techs are way down still. So Facebook's way down, for example.
Yeah, the thing is, they're coming up with the results, and it's well worth looking at it. But looking at the results, I guess I don't want to say ignore these results, because these results are important. I guess I feel as if these results we're still in this transition zone though as well, where we've seen so these results are coming out for the period from April, May, June, and so when did we first get the first rate rises in Australia? Was May. And so I feel like the Fed was 2 months before that probably, and then so those types of things don't. They take a while to flow through. So we're still looking at a period where, let's say you're looking at Australia and looking at results, and the company's going, yeah, things were all right. They're starting to, soften off a little bit at the end of June, but, we're still up, whatever it was, Maya, for example, up 15, 20% on whatever it was last year. And so you got to sort of say, well, okay, last year was a bad year as well, but they're looking at it, we haven't seen a period in which we've seen the effects of what's going on. So looking at the outlook statements is really important. But in times where you go through macro changes, companies tend to be one of the last ones to actually come up with it. So if you are sort of saying, oh, you know what, I'm going to wait until I see company earnings really start to turn over, and that's when I'll sell everything, you'll usually be too late. And the reason why is because most of these companies, when they come up with their forecasts, they go around and ask, all the salespeople, what are you expecting to do in the next quarter? And they're like, oh, I've got this many offers out, this many things. And, if I usually get 50% of them in, and so that'll give me a forecast. They add them all up and they go, okay, that's what we're expecting. Now, those salespeople aren't macroeconomists, and they're not sitting there going, oh, the RBA's just upped rates, and, 30% of people are going to have a 40% increase in their mortgage rate. And so therefore, maybe I won't sell as much. They generally go, well, I sold 10% more last quarter, and so than the prior year, and so I guess I'll send 10% more this quarter. And so it's not to say company numbers aren't important. They are. It's just to say at turning points, don't, if you think there's a turning point coming, and that's where I am, I think there's a turning point coming, I don't use the numbers to sort of justify, I don't use sort of, the fact they're holding up to say, oh, I must be wrong. I'm looking for other measures to say I must be wrong, because that one isn't going to tell me I'm wrong. There are other things that will tell me wrong, but that's not one.
I think that's a very good observation. And, turning points is always the interesting question. When is a turning point a turning point? And when is it just a bare bounce before it goes down again, right?
Yeah, and a great example of that, of a similar type of thing, talking to companies, was during the whole crash, the financial crisis. The company I was with was doing a lot with mining services companies, and the analysts were talking to the mining services companies, and the mining services guys, talking to the CEOs there, and they're banging the table saying this project is still going ahead. I called up my guy at BHP and he said, it's all fine. It's going ahead. Or I called up my guy at this other big mining company and he said it's all going fine. And so, and that's a reason to keep buying our stock. The thing was, that guy was speaking to a manager, 3 levels deep at BHP. And at the top level of BHP, they're going, we're going to have to shut down all these projects because, there's this huge crash going on. They're not telling that to all the employees. To the employees, they're saying, yeah, keep going, business as usual. Because if they don't, if they decide not to go ahead, they don't want all their people saying, oh, you told me last week you're thinking about it. Now I'm worried about my job and all that type of stuff. They're like, no, we won't tell anyone anything until we've made that decision. And then we're like, yes, bang, we're pulling that $10 billion project. Yeah. And so at the time, you've got analysts banging the table saying, I spoke to the CEO spoke to the company, everything's fine, everything's going ahead. And a week later, the whole thing fell over. And so, I guess what I'm saying is even when you think you have information that's solid and from people working in the business and on the ground, you need to double check, okay, well, if something is changing, are they the types of people who will know? Or are they going to find out at the same time everyone else does, where there's a press release and BHP's just pulled a $1 billion project?
Absolutely, yes. It's going to come to late to the day. And very interesting, I'll put this up again because MD said, very important point, company forecasts historically late at downturns. And of course, somebody else asked, I think it was Kieran, let me just find that one. Yeah, this one go. Have earnings forecasts been downgraded yet? And the answer is in the US, some have, some haven't, right? But something like, is it 80% have actually come out better than expected?
Yeah, I hate that whole part. I mean, it's what happens is I always look back. I look back a bit, and then I look at so when I look through analyst forecasts, I go, tell me what they were forecasting a month ago. And so at the end of June, I want to know what the forecast was, and then the company comes out with a number now, because what will happen in the interim is analysts were all forecasting the stock was going to earn $1, and then the company gets to 30 June and goes, we're going to make $1. We'll be lucky to make 80 cents. We've done some rough numbers. We still need to get them, go through and have the accounts and do everything, but we know enough now. And so they'll go, okay, so announcement to the market, we're not going to do $1, we're only going to do 80 cents. Something, or 80 to 85. They'll come out with a range. And so the market then downgrades and stock sells off. A month later, they report their earnings, and all the analysts have say downgraded to 82. And the company comes in and goes, oh, we did 84. And they go, oh, that's a beat. We've just beaten our forecast. And you're like, you're 16% lower than what you were, 3 weeks ago. That's not a beat.
Yeah.
And so looking at that. And then the other one is looking at forecasts in terms of saying what's happening next year. Yeah. Are those numbers going up or are those numbers going down? Yeah. And generally speaking, look, it's very early days in this reporting season so far. So you really don't have enough information to sort of make broad statements. They haven't turned down in a meaningful way at the moment. And I suspect for this reporting season, you're not going to see them turn down in a meaningful way. There'll be ups and downs, and you'll get some ones like Walmart's and some of those ones who are a bit closer to the consumer, who are going to be seeing that and giving you guidance. But I think we're a couple of months away from really seeing the major downgrades. If it hasn't happened by the next reporting season, then then we'll have to start asking, okay, well, maybe we've got this wrong. Maybe the consumer is stronger than what you think. But I think this reporting season, I'm expecting earnings forecast to sort of hold up not too bad, and then start to see some further downgrades over the next quarter.
Yeah, and what's fascinating about this is the lags, right? Because if you think about how quickly rates have changed, right? It's just a few months. It takes time for that to work through into the actual results that the companies will actually be presenting. Right?
Yes.
And the question is, how accurate are they going to be based on this fast-moving? I'm not sure I've ever seen rates move so fast up from where they were, ever. So that's something else to bear in mind in terms of trying to get to a level of certainty about things. Is tough because there are so many quick moves that we've probably never seen, and we don't have the mechanisms to judge the impact in real time.
No, that's right. And so where can you look? So there's things like some PMIs, purchasing manager indexes. They're all turned pretty bearish pretty quickly. You can look at things like credit card data and stuff like that in terms of trying to get that real leading edge stuff. But that data can be really, really noisy. You can see these massive falls and then a massive rise again because I don't know, a public holiday fell on a Monday rather than the Sunday, or whatever it is. There's just weird things in terms of week to week data that just throw your numbers out and make things look different to how they were in prior ones. But and that's the position we're in. It's there's 100 different fast moving indicators you're watching. One of the fascinating ones you saw 4 or 5 weeks ago. Well, maybe not even that. Maybe about 4 or 5 weeks ago, probably. Was as say Target started to worry about its started to have these problems in terms of its supply chains. In terms of its having too much inventory, is you actually saw the transport numbers, local transport numbers, really dropped, and orders out of China really dropped. The rest of the supply chain was pretty good in terms of the whole middle of the supply chain. And so, if you're a bull, you look at that and go, oh, well, a bit of weakness over here, a bit of weakness over there. The middle seems fine. It's all good. But actually what had happened was that filled up, so they're no longer sending goods from the warehouse to the store because the store had too much stuff and couldn't get rid of it. And then they'd stopped ordering from China. And so the middle part was all the orders you'd made last month, in the last few weeks. And so it hadn't had time to wash through that supply chain yet. And so, there's that type of thing where, the early indicator was the slowdowns at either end of the supply chain and not trying to look at something in the middle of the supply chain. And so, anyway, just one example of 101 different ways to try and work out what's going on. And it's not just one signal. You got to be trying to use as many as you can to get a good feel.
And the Atlanta Fed, of course, in their now GDP thing is quite interesting, right? Because they try and get all of those real-time, quote unquote, feeds, and they don't do any processing. They just say, well, that's what the answer is, and they're sort of suggesting a slight fall, about one to 1 and a bit % down over the quarter. Right? Which is interesting.
Right. And they've certainly been leading. It's been leading analyst economist forecasts in terms of the economists have been they've been basically following that nowcast down. You know what I mean? That nowcast sort of went, and which isn't always the case, but certainly this time, that's economists were a lot more bullish on that.
So I wanted to sort of bounce this off you, Damian. There was a little comment earlier from let me just put that up. The US dollar, the safest fiat currency, gold, the safest real hard money, right? That was the sort of stake in the ground from Bob Jones. And then I thought, well, okay, but if I look at gold,
hasn't been pretty.
Gold is not pretty, right? It's 1716 at the moment. Okay, it did hit a sort of a peak, at one stage when it was actually at an exalted 2,077. And I remember talking to Peter Schiff about a year ago, and he said, no, gold's worth at least 5,000 to 8,000. That's where it's going to go. It doesn't seem to have behaved like a hedge against inflation should be behaving.
No, but it's been better at hedging against inflation than Bitcoin, though.
Well, that's true. That's not a hard target to meet, though.
No, that's right. The digital gold. Certainly. So, I think we've spoken about it a few times on this, that, gold is, it's a greater fool investment. I need to find somebody else who's going to buy it from me. There are industrial uses for it, but they're so rare that, it's actually what drives it is, are central banks buying it or selling it? Are investors buying it or selling it? And there's so much out there like that. That's, you get that answer right, then you've got for that. So you know where the gold price is going, and so there is an element of it gets treated as a currency as well. So some of this is the fact that the US dollar has been so strong. So I often think of gold as an alternative currency, is in terms of where I'm thinking about what's happening, and whether. If we're going to hold something in a portfolio, it tends to be, well, at this point in time, it's a very small holding as a hedge in terms of saying, well, I might get these other calls wrong, and if I do, then gold might, gold will offset some of that. I think in terms of you could talk in terms of production and all these types of things like that, but as I said, I really don't think any of that really drives it. I think it's an investor sentiment. Probably not as bad as investment sentiment as, say, a Bitcoin or something like that. But if you get some benefit from when the Fed's out pushing money onto everyone. There's lots of liquidity sloshing around, and all these assets tend to go up. But I think when you've got the opposite happening and money being withdrawn, then you see a lot of the Bitcoins and golds and alternatives suffer as well.
Yeah, just seeing.
Sorry.
No, go.
And that takes a point about the. I guess what you're saying there about that inflation hedge. I wrote something 3 or 4 months ago when copper was $10,000, and saying that it's not a super cycle. When the issue with copper is that the price is in a super cycle. It's just that the volumes aren't growing, and that just means it's a normal cycle. And at the time, and even still to a certain extent now, all the Wall Street banks were out there banging the table. The only thing that will save you from inflation is commodities. The only thing, you have to have as much commodities as you can in your portfolio, Martin. That's the only thing that will save you from inflation. And 30% of that's just evaporated. So you're going to need a lot of you need a lot more. You need a 40% increase or a 50% increase just to get back your inflation adjusted ones. And so I think there's a bit of a lesson there for. I don't want to be too down on it right now, because you probably see a bounce. I'm pretty good at making these statements and seeing a bounce, but I know at the time, $10,000, I had a fair bit of hate mail in terms of people saying, no, you're completely wrong. This is, you've got your inflation call wrong, and this is the only thing that can save you. And a lot of that comes back to that whole EV story, where you need a grain of truth behind any of these bubbles. And copper and copper's got that grain of truth in terms of everyone saying, okay, you need way more copper in an electric vehicle than what you need in a normal car, about 35 kilos more, and there's 100 million cars built every year, and so look at all this extra copper that's going to come on. And so that's the whole. There's a bull market there for the next 20 years, and I need to see the numbers. And so I look at that and I go, okay, well, so you're doing that. That gives you about, 100 million cars, 35 kilograms. That gives you about another, 3.5 million tons of copper. And some of that's going to be recycled. So maybe it's less than that. Maybe it's 3 million tons. That's 10% of global production over 10 years, like 1%. If you can increase copper production 1% per year, you can meet that. What it doesn't cover, though, as well, is that we spoke about these Chinese houses. So right now, if you just add up all the floor space under construction in China, there's enough houses being built for one in every 6 people in China. One in every 6 households in China is having a house constructed for them right now. That uses a lot of copper. The average house there or apartment uses about 130 kilos of copper. So if you don't build one Chinese apartment, you've got 4 more cars that you can build. So you've got, there's an offset there. There's a lot of copper needed for if you're building new solar farms and new transmission and all that type of stuff. Absolutely, you need some. It's not a huge amount. You add like 0.5% or something like that to the supply, and you get there. But there's actually a reasonable chance that we go the other way. And if we go to more microgrids where you've got more local things where a few 100,000 people, you've got wind farms and solar farms and big batteries and all that type of stuff. They're doing it in WA already in remote regions. But if that's the way it goes, and I'm not saying it's definitely going to go that way, but there's a reasonable chance you go to sort of a whole bunch of microgrids everywhere. Then we actually rip out a whole bunch of these transmission assets, and we've got all the spare copper. So we're going to use less copper, going forward than what we're using at the moment. And so, I think that's whenever I see these sort of bubbles and super high prices, getting behind those numbers and trying not get carried away with things that have shot up, and trying to say, well, is there a fundamental reason this is going to keep going, or is actually to take the other side of that bet.
Yeah, very important. And in fact, I was talking to a couple of hedge funds over the last couple of days who went deep into commodities, and they didn't get out in time, right? And they've got this big hole.
Yes. Yeah.
Easy to do.
Yeah. And so I know, and I brought a few charts on lithium as well that I might share, because I know I've been asked a few times on here about lithium. So lithium is in the super cycle. So let me get that straight, because we need lots more of it.
Okay. Do you want to share screen?
Yeah.
You're sharing it. I just want to show. Do you want me to show it?
Yep. So the commodities lithium. Yes, that's the one.
Yep.
So the thing I just wanted to highlight with lithium is there's lots of lithium out there. I've got the list of the top dozen mines that are out there based on their reserves and resources. So you can see at the top there's this salt flat with 39 billion, I think, tons. I'm not sure if I've got those numbers.
It says T. Is that trillion? It
says T. No, it's not trillion. Yeah, not quite sure exactly. Yeah. Anyways, there's a lot of copper out there. Sorry, a lot of lithium out there in that one. The biggest, the green bushes at the bottom, you can see there with 3.7 million. That's actually the largest operating one at the moment. So they're actually producing the most in the world at the moment. So you've got the top dozen by the amount of lithium that's in the ground, and number 12 is the biggest one in the world at the moment. So you've got 11 bigger than it that you can expand. So we know where the lithium is.
Supply is going to increase.
Supply is going to increase. Absolutely, there's going to be lots of supply coming. And you can see that the top two they've already started construction. Who knows how soon they're one's in Bolivia, the other's in Argentina. I think when you see the construction started in Canada's and the US and places like that, and China, you can be more certain that it'll be on in a reasonable amount of time. Sometimes the more developing countries take a bit longer to come on. The other one I want to show is I've got this supply curve up. Now, this is what they it's a mining cost curve, cash costs curve, and what it shows is when they pull something out of the ground, how much does it cost and by each mine. And so on the x-axis is all the mines, all the producing mines in the world, and the wider bars are the mines that are producing a lot. So the one you can see down on the left, there's like this really wide one, which is the green bushes in the one I just spoke about in Australia. And each of the different colours is sort of showing you the blue is the mining cost, and then the red's the milling cost, and it sort of goes its way up, and the orange is the royalty payment that comes out on it.
So, the lower the bars, the better. In other words, it's cheaper to produce.
Yeah, cheaper. So and you're producing about less than $2,000 on those ones. The current price is 50,000-ish. There's a whole bunch of different prices, but it's roughly 50,000-ish. And it was sort of $5,000 not that long ago. So you're in this. They're all making bucket loads of money. This graph goes to 10,000. So even the most expensive ones are making 5 times as much money. The thing you can really notice though is there's two different sets of colors. The ones on the right there don't have any mining costs. And that's because these are the ones that are actually the salt. They're on the salt flats, and basically a lot of them are sort of pouring water in and dissolving and then bringing it back up again. And so there's very different types of lithium. So if you're digging sort of the hard rock stuff and you've got reasonable things, you're going to sit on the bottom of this cost curve, or you're more likely to sit on this bottom of this cost curve. And when the price does come back to sort of $5,000, $10,000, you're not going to be the mines copying it. The salt ones are at the upper end. They're the ones when the price does come down, some of them might need to shut down or shutter or whatever it is, and then off you go again. But the real killer chart on this one is this final one, which is just sort of showing you the demand and supply growth. And this is, I can't actually remember. I grabbed this from a broker report, and unfortunately I haven't. I copied and pasted and forgot which one it was from. So I apologise for not having a source on this. But this was just their forecast about the demand versus the supply going forward. The real issue is that little red line is the market balance. So sometimes it hasn't got enough, sometimes it's got too much. The issue is they're growing so quickly. These lines are growing by so much every year. I would have almost no faith at all in that last year's forecast. By the time you reach there, it could be positive, it could be negative, who knows? Like those lines are, if one of them grows by 1% more faster over that time period, the other one grows by 1% slower, then you end up in exactly the opposite case to where you are at the moment. So I guess what I'm saying is there's so much new supply coming on. It's going to be very hard to try and tell what's in balance and what's not in balance. But I can tell you at $50,000, I wouldn't be buying into the hype. Maybe it'll go higher because there'll be shortages or wars will break out or something like that. Funny things can happen, but you're more likely to see prices in the long term in the sort of $10,000. It'd be much closer to the right level. If it's below 10,000, I'm probably jumping in and buying. Close to 50,000, you're not, and in between, you're really trying to guide that cycle. So lithium, yes, it's in a super cycle. Yeah, there's lots of different batteries coming, but there's also there's 100 different companies out there that have raised significant money in the last little while with all these different battery technologies, and so lithium will probably be the winner out of it, but maybe not as well. So there's lots of uncertainty there. Buying at the highest prices you've ever seen, when the production is so cheap and there's so much of it out there, hasn't been a good strategy in the past.
And what's interesting about that, because that philosophy about looking at the mining sector and trying to work out what the cost to mine is relative to the market, that's a very good logic to apply, not just for lithium, isn't it? That you can pretty much apply the same logic to all of those other things that are pulled out of the ground. Yeah,
absolutely. Actually, I'll use that. I'll show you one other chart as well on the copper while I'm at it, because that's the one. The pushback I quite often have on it is, look, copper's they're just not digging up as much. You used to, 10 years ago or 20 years ago, you get 1% copper, and now you're getting 0.5% copper or 0.2 and all that type of stuff. And I go, yeah, absolutely. That's definitely coming down, but it's been coming down for 150 years now, ever since we've got data. So they used to dig it out at 15% copper back in the day when they had pickaxes and shovels. But we haven't got pickaxes and shovels now. Like the mining methods now, you've got these massive underground mines that are, and they're automating more and more of it all the time. So yes, grades are falling, but they've always been falling in the copper market. And so my take is that, look, there's the speed of which the cost to get the copper out is really not that different to what it's been over time. And if you look at the number of years we've increased the mine supply, so this is sort of showing total copper plus recycling. It's sort of gone from 1950 less than what was that, 5 million tons per annum, and now we're doing 30. And at the time in 1950, there was like 40 years of mine life left that they'd identified. And now we have roughly 40 years of mine life as well. Like there's, yes, we're producing so much more, but we're, they keep finding more of it. And also, there's copper that people found that was, when they were digging out copper that was like, 2 and 3%, they found some copper that was, 0.2%. And they're like, oh, not worth doing. That's not a profitable mine. Whereas nowadays they're like, oh, we've got all these different mining methods. Actually, it is a profitable mine at that level. So,
yeah, very interesting. Thank you for that. Now, Kieran asked twice. Actually, he's asked this question twice. It's time to bring it up. In the recent bounce in the markets, is it institutional money or retail money that's actually driving it? Because certainly we know that some retail investors were piling in and out, and we know that some institutional investors were sitting on the sidelines and saying, no, we're not there yet.
Yeah, I don't know the answer, actually. I'm trying to think where I've seen institutional investors have generally been sitting on the sideline. Yep. and for most of the last 6 months. I haven't seen stats to say whether that's true in the last couple of weeks. So,
the last data I saw was a couple of weeks ago, and at that stage, the institutions were still not playing much at all.
Yeah. But I couldn't say, sorry,
No.
that one as to the last few weeks.
Yep.
It has been driven by retail recently, so I'd be guessing it still is.
Yeah, my suspicion is, and maybe some people decide to get out of crypto and try their hand elsewhere, you know.
I think, well, I don't know. If you're getting out of crypto, you might not have quite as much to influence the market as you once did.
Depends on when you bought in.
Yes, that's right.
Yeah. There's a few people talk about NFTs. I'm not going to go, other than to say I'm not convinced about NFTs yet. So, you know, I don't know whether you are, Damian, but
look, I'm not. I don't own any NFTs myself, but then again, I don't own any, you know, Picassos or anything like that either. So, you know, the net effect is I look at this and I go, well, I could get somebody to paint me a Picasso that you wouldn't be able to tell the difference between the real one and I could hang that on my wall, and you know, you wouldn't. But we'd both know that's not a real Picasso. It's the bragging rights, and that's the one I look at them NFTs as, saying, well, okay, yes, there's a picture here that somebody's taken of whatever Michael Jordan dunking, and somebody owns the NFT of it, and but the net effect is, you know, it's bragging right. Say, oh, well, you can show that picture, you can look at that picture whenever you want, but I have the bragging rights. So, how much do you want to pay for bragging rights?
Yeah, absolutely. I certainly think that there's a certain amount of hype attached to it, which maybe has been diffused a little bit by the correction that we've seen in the crypto space and some of the bankruptcies that we've seen. I make the point, Damien, it's very interesting. If you look at the failures in crypto, how a lot of these are connected to each other. So there's, you know, a hedge fund, and then, you know,
cascading
crypto bank.
And the other thing I'd be watching out for if you're in crypto is that because these have been falling over, you know, a lot of cryptocurrencies are really securities. Like they're you know, they've got basically all the features of securities, and so they should be covered in the US under the securities laws, but they haven't been. Securities regulators are now looking at them. You know, as regulators tend to do, is they'll shut the gate once the horse has well and truly left the paddock.
Yep.
And so the issue is, because you have had these values now, the regulators are now looking a lot more closely, and they have complaints of, you know, here's somebody's grandmother who bought some because a grandson told her it was the greatest thing ever and has just lost all this money and is complaining about it. You could see some regulatory crackdowns coming. Yep. So, yeah.
Plus, of course, central bank digital currencies are still now bubbling along, and the Treasury is looking at it in Australia for retail. The US is looking at it. The UK is looking at it. Other countries looking at it too. So that's the other context that I think people often forget when they think about crypto, right? The central bank alternative is now looking as though it's definitely going to take some sort of shape. And in fact, some of the top-down guys, you know, the World Economic Forum and the UN, are talking about, wouldn't it be nice if you could connect central bank digital currencies in different countries? And it feels like a one-world currency to me. I'm not sure I want that.
Well, and at that point, all of a sudden, the regulators have even more incentive to crack down on the non-bank central bank.
Absolutely, yeah. Well, this has been my argument for quite some time. It's actually quite a convenient reason. Well, you know, obviously cryptos, you know, blah, 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 you know, we can't protect you from those. But here's a nice, shiny central bank digital currency that we'll look after and stroke it gently and, you know, have some of this. Right, and then when they cut rates and go into negative territory, they say, well, we'll give you some dollars or digital equivalent of dollars at the central bank account. And by the way, make sure you spend the next 6 months or you find the value goes down. Yeah.
Well, and you know, I think to me, that's great. Like to be able to say, like, I would love to see a monetary system that said, you know what, interest rates can't go below, I don't know, 2% or 3% or pick whatever the level is, because weird stuff happens and you get asset prices go crazy, and you know it all goes. When money has no costs, things get weird, and so you put a sort of a limit on it, and then you do. So rather than treating zero or negative as your lower bound, you can have a higher one. And if you want to stimulate more, just give money straight to the people. Absolutely,
yep.
You know, I'm very much in favour of that as a. So fingers crossed.
I can hear the helicopters going across now, just throwing the dollars out the window, right?
Well, that's and. Oh well, you know, it's sort of and I think for pensioners and things like that, it makes a lot more sense to say, you things get bad, rather than saying, hey, you'll bear the brunt of it while we try and get more people into houses. Say, oh no, if we hit a certain level, let's give everyone some more money.
Well, it's certainly true that the stimulus programs that were done over the last couple of years in particular have not actually achieved what they set out to achieve, right? If you look at where the money landed, who were the winners and who were the losers, it was a complete joke, really.
Well, it depends on who. You're obviously not cynical enough there, Martin. Maybe the money did land where it was intended to land.
Okay. You mean it was by design? Yeah. No. Okay. Yes.
So what you're saying is companies made out really, really well.
Yeah. Companies that didn't actually have profit issues ended up with JobKeeper, and those sorts of things. It's a big number.
Yeah,
right?
That's right.
And the term funding facility, just to be clear, the term funding facility, 0.1%, right, was given to the banks. The banks have now parked that back at their reserve accounts at the RBA, and the RBA is now paying them interest on the money that they've parked there.
Yep.
How does that work?
So well, as I said, it's money landed up exactly where it was meant to.
Yes. Maybe that's right. Maybe I'm just I'm not cynical enough.
Not cynical enough.
Now, Yogi Bear asked this question, and thank you for the super. I'm not sure I'm going to answer it and whether you can, but which South American country will the US bring democracy to next, in quotes? We'll maybe leave that hanging unless you've got anything profound to say, Damien.
No, look, I think, what will I say in terms of this? No, let's leave that one.
We'll leave that one hanging, exactly.
Yeah.
All I would say is that there are sometimes official reasons for doing things, and then there are the real reasons for doing things, right? And quite often there's a whole another agenda that we don't necessarily see. And if I go back to the 70s, the petrodollar and all of that sort of stuff, there were decisions taken for reasons that actually were internally coherent from an economic point of view if you have a particular perspective, but actually if you look at it more generally, you think, what? That can't be right.
Yeah. Well, and I mean, I guess I would say, though, that given what's happening in the Ukraine and tensions with China and Taiwan, my expectation is that the US won't be too warmongering in its own right, in that it doesn't want to set a standard that Russia or China can point to and say, well, we're just following your lead. You invaded that country or took over. That's why we're trying to overthrow Ukraine or government or restore Taiwan to its rightful place type thing. So yeah, but with that in mind, I think the US isn't going to be too warmongering. I do think that whole discussion we had about developing countries and the problems they're going to have, as you spoke about with Egypt and food. The last time we had that was the Arab Spring, was when there were food price problems. So entirely possible that you start seeing, and we've already seen it in Sri Lanka, regime change there. So
So for me, the biggest risk that I see at the moment is to do with Ukraine. In the Donbass, where the Russians have now taken over, they're starting to hand out Russian passports, and they're planning to do some sort of referendum in a few weeks to effectively get the people to say we're now part of Russia. Right?
Yeah.
Now, if that happens, that changes the game, because suddenly now Ukraine is now not clawing back their own land. They are effectively tackling Russian territory, right? Now, that's going to create a whole bunch of fallout with regard to the way that the West is thinking about it and Russia's thinking about it. I think the fragility there is probably, for me, one of the biggest risks that I see at the moment in terms of how this plays out ahead.
Yeah, I mean, certainly it feels as if it's got to the bogged down stage where gains and losses in each direction are going to be difficult to come by. I think Russia, I do think, has a looming problem in terms of just being able to get the chips and all the types of stuff it needs to run its army, or certainly the more technically advanced part of its army. So I do think the longer this goes on, the more it does benefit the Ukraine. But as I said, I'm not expecting a fast resolution in either way, and yeah, there's 101 things that could go wrong in either direction to make things accelerate, and make things worse. So,
and I guess that's the sort of the point as we sort of come to the end of the show. That we are still in a very uncertain environment, right? You know, in all the years I've been looking at this stuff, I think I've never seen so many different things all sort of pulling in different directions, and you know, creating a whole morass of problems and issues. Makes it very tough to navigate.
Exactly, and that's where we speak every time about the biggest concern we have is policy error, and so in this part where there's this massive uncertainty in terms of coming out of COVID, China still going in and out of lockdown, supply chains, are they coming good or not? Ukraine war, is that what's causing more problems with supply chains, and then energy prices shooting up? Is that we then have central banks go, look. Given that backdrop, we need to raise rates faster than we ever have before in the history of central banking.
Yeah, so exactly. And until something breaks.
Yeah.
And the question is, what is going to break? Now, talking about what might break, I did put a poll question up, and it was, where do you think the Aussie dollar will be in a year's time? It's 69.52 when I put it, right? 25% said higher, 50% said lower, 9% said the same, and 16% said it was impossible to tell. So there you go. You take your money and you pay your choice, I suppose. Any thoughts, Damien? Higher, lower? Where do you think it's going to be?
I'm with the majority on this in terms of being lower, but that's based on my my view about that. I think the Australian economy is going to be hit worse. I think we've got higher interest rates. I think we're going to get hit worse. Yeah. I do think China's not bailing out its banking sector. It's property developer sector. It's really just trying to minimise the pain for people now, as opposed to try and get things going the way it used to. And I think they all add up to a lower Aussie dollar. Actually, that's probably a good time to show the that chart I sent you before as well, Martin.
Yes. Let me just find that.
This is valuations of Australian stocks.
There you go.
So what I'm using is the forward price to earnings ratio. So what that means is we look forward, we look at analyst forecasts, we put them all on the same basis and look forward 12 months so that we're, so we've got a 12-month forward earnings and we compare that to the current price. And that tends to be one of the better measures of valuation in terms of seeing what's going on. The top left chart, what I'm doing there is comparing Australia to the world when you do that. So if it was at 1, it'd be the same price. So the world PE would be the same as Australian PE, and generally the Australian PE is a little bit less than the world PE. You can see there, and right now it's actually a fair bit less than the world PE. So at face value, you go, oh, the Australian market's cheap, and then I go, well, yes and no, because the Australian market is chock-a-block full of banks and resources, and so if you strip banks and resources out of the Australian market and say, show me, and that's what I've done on the top right, is show me what banks and what the Australian market looks like, excluding banks and resources, and compared to the world banks and resources, we're actually really right up there in terms of where we're sitting. It's expensive at this point, and the other problem then, and then in the bottom two charts is then saying, well, let's see what if you're going to strip something out, you should at least have a look as well to see where it is. So then you look at the Aussie banks versus world banks, and you can see they're actually even more expensive. So they're sitting at these levels you've never seen before. So, which is a little disconcerting from my view. I mean, this is always the concern with these ones, is that that the Aussie banks have this reputation as being a widowmaker trade, when you want to go short the people who don't want to own Aussie banks and go short the sector, and they just keep going up. They've got a great relationship with their local regulator, and the RBA seems to be happy to step in and help them out whenever things go really bad. But they've never been this expensive, and the outlook, as far as as we've spoken about over the last hour or so, looks pretty bad for in terms of interest rates. So either we've got something completely wrong, or the market is it's either me or the market, and I think in this case it's the market. And then the bottom one is just the resources one, just for completeness, and it's basically Aussie resources versus global resources is roughly about where it's always been, and it's slightly expensive relative to the world, but nothing to sort of write home about. But yeah, so definitely the Aussie banks relative to the world, and anything else that's not a bank or resource looks expensive in Australia.
I think that's a really good object lesson, which basically says don't just take the top level view. You've got to come down a level or two to see how the different elements are moving, right? Particularly now. And if you do the same in the US as well, you'll find that, for example, in tech stocks, there are some tech stocks doing really well. There are others not doing well at all. And the average masks those big differences. So you've actually got to go really quite granular, I think, to really understand what's going on.
Yeah, absolutely. And that's that. This is this part as well to try and work out as reporting season kicks on. Is you'll and you go into the next quarter. Is I spoke about. That's when I'm expecting really to start seeing these earnings come down. Is working out which companies you're looking at as well, because there are some companies that are they're this late cycle, just always, and so and so they're not the companies you're looking at. So something like like employment's pretty lagging in terms of an indicator. Usually one of the last things to fall, and so so you might be looking at some of the HR stocks and going, okay, well those earnings I might not might not use those as my leading indicator, but I might be looking at some of the Walmarts and things like that as when things are starting to fall off.
Another example, NVIDIA versus Amazon, right? Both in the tech sector, but NVIDIA quite narrow and, in what they do. Amazon's got cloud and a bunch of other things, and so a very different mix of businesses in that particular organization. So putting them together masks the very important differences. Yes, yeah, absolutely. So thank you. Now, one last question from Jason. Thank you for the super chat. Cheers, Martin and Damian. Does Damian think the problem with grain supply could impact the world and the share market in some way looking forward? Could it lead to adverse outcomes worldwide? The short answer is, I think probably so. What do you think? So
sorry, this is the grain supply, was it?
The grains problem with grain supply.
Yeah. Look, yes and no. I guess I look upon commodities, and one of the good things with commodities is they are very resilient compared to other supply chains, insofar as we're used to having floods in certain regions, or just really bad weather, really bad planting weather in Canada one season, and then the next season it's fantastic and it's really bad in Australia or Brazil or the US. And so we are used to small areas of the world being taken completely out. And there is a fair bit of substitution you can do around. It generally tends to be in feedstock for animals. So there's plenty of soybeans that are out, so that's what farmers are feeding. And then the next one, it's a different crop that's cheaper, and so that's what farmers end up feeding their cattle or their whatever the feedstock is. So that sort of helps to even things out a little bit. If you get a cascading effect though, so you take out a major supplier like the Ukraine, and then you have a bad planting season or a bad cropping season in the US or Brazil or different areas, actually not Brazil, but Canada, Australia, you pick a few of the other bigger producers, then yes, you can have problems. I do think a lot of people talk about, Ukraine and Russia are these big producers. Russia will sell their wheat somewhere. It'll, yes, it may not be to Europe who won't take it for political reasons. But there's plenty of other countries out there that will. India is more than prepared to deal with Russia. China is more than prepared to deal with Russia. There's 50% of the world's population almost. That's not going to be a problem. What else was I saying? So that was the grains. So yeah, I'm not looking upon the Ukraine being taken out as being an event which is absolutely going to cause problems, but I'm looking upon it as saying, okay, it's vulnerable now. If you get some other cascading events and you get some particularly bad growing seasons, then you can see some more problems. And I do note as well, though, there do seem to be there's certainly movements for certainly movements in terms of negotiating about bringing the wheat out, and there's discussion, that potentially the US could even just start sending in their own ships to Odessa with with support with a battle cruiser next to it, and sort of sail in and collect wheat and sail back out again. There's discussion about that. I mean, that was sort of something that was happening, has happened in the past in the Gulf. And potentially, if things were looking bad, that's certainly something that's being discussed as well at sort of high levels. So I think there's ways out. Not to say you can't be a crisis. You absolutely could be a crisis, but it's not one I'm imminently worried about at the moment. I do think there's enough ways around it that I'm watching it, but not alert, but not alarmed yet.
Thank you very much for that. Okay, and Cookie Boy asked, next Tuesday, 50 or 75. I think it's hard to know at the moment. Depends on what the Fed does. I think 50 is the most likely bet. I don't think they're going to go hard. But that's my own view, but who knows?
Yeah. Look, I don't have a special insight into the RBA. I hope if it's anything, it's 50. I hope it's less than 50, but yeah.
Well, Damien,
they're going to. I think he's right. It will be 50 or 75, but unless something incredible happens between now and then.
Yeah, who knows? Well, thank you very much for that. And we should just say that you're the head of investments at Nucleus Wealth and Walk the World Funds. If anybody wants more information about the Walk the World Funds, there's a link you can follow and get a lot of information. Transparency is there. That's the whole reason why we do what we do, right? And in the current environment, that's important, isn't it?
Every stock, every bond, and why we have them. So yeah, you get to look and see, and then a lot of that reason is because people who are listening to me go on for an hour are obviously quite interested in investing themselves and probably want to be able to do a bit themselves. And so the word nucleus is this idea that there's a central part of your portfolio, the lower risk stuff, the large cap shares, government bonds, the more boring stuff that you can sort of leave in your portfolio, and if you want to do more interesting stuff around that, you do that. But the full transparency, you can see what we've got, so that if you want to buy some more, you want to buy Tesla, and you can look at us and say, well, they don't have any, so I'll buy more than what I thought. Or you can look and say, well, no, I want to buy Google or Facebook, and actually you've already got some. I'll buy less than what I thought I was going to buy. So.
Indeed. Thank you very much for your time, Damien. As always, great to share your thoughts and get some insights from the stream as well. Hang in there. It's going to be an interesting ride the next few weeks, isn't it?
Absolutely. It's well, as I said, we're positioned for further downturn, but looking to see whether where we might be wrong, I guess is where we're looking for.
Always think about what happens if. Thank you very much. Have a good evening. I'm going to take you off stream, and I'll just close the show out now. See you later. Thanks. Well, there you go, folks. I hope you found that useful for some deep dives there, which were very, very valuable, I think. So thanks for spending some time with us. And just to remind you that next week, David Llewellyn-Smith's coming on. We're going to talk about energy in more detail, specifically the gas question and how to play that. So very, very relevant conversation there. So mark your diary for that one. And before I go, of course, we have to just revisit the doggies. They're still, look, Luna's decided to get up and walk around a bit. So she thinks it's time for the final walk of the evening, so she can hear that I'm about to take her out, I think. But there you go. So there's the doggies. Okay, thank you very much for your time tonight. Thanks for spending some of your time with us. I hope you found that useful. Do watch the recorded shows during the week, and come back next Tuesday for another live show. And we'll keep an eye out. We might do a Sunday evening live property show in the next week or two, so keep an eye out for that as well. This is Martin North from Digital Finance Analytics signing off. We'll see you next time. Cheerio.